If you're a UK pensioner who's earned even £1 over £1,000 from a side income this year, selling online, letting a room, a bit of freelance, HMRC already knows. And from January 2026, that information is landing on their desk automatically. There are 6 traps catching pensioners right now, and I want you to stay with me until number 6, because that's the one almost everyone gets completely backwards. Get it wrong, and you either pay a penalty you never owed, or you panic over paperwork that was never coming for you. Let's start with the line that decides everything. Number 1. The £1,000 line, and here's the catch. It's your gross, not what's left in your pocket. HMRC gives you a trading allowance of £1,000 a year, and a separate £1,000 property allowance if you let something out. These two allowances don't combine. You can't add them into a £2,000 cushion for a single online business. If your side income stays under £1,000, you don't even have to tell them. But that £1,000 is measured on the total money that came in, before you take off platform fees, materials, postage, or petrol. This is where pensioners lose. Take Sandra. She sells knitted items on Etsy, £1,400 of sales over the year, £600 of wool and fees, so she tells herself, my profit's only £800, that's under £1,000, I'm fine. She is not fine. HMRC counts the £1,400 that came in, not the £800 she kept, so she's over the line and she must register. That's the mistake, counting profit instead of turnover. And it bites on the property side too. Margaret rents out her driveway to a commuter for £110 a month, £1,320 a year, and never thought of it as income, but that's over the property allowance and it counts. So this week, add up every pound that landed in your accounts from side income since the 6th of April 2025, before any costs. If that number is over £1,000, you have to tell HMRC, even if the tax owed is small. Number 2. The online platforms are now reporting on you, and this is what the so-called new 2026 audit really is. Since January 2024, digital platforms eBay, Vinted, Etsy, Airbnb, Uber, the letting sites, are legally required to hand your sales and earnings straight to HMRC. The reporting kicks in once you sell 30 or more items in a year, or take around €2,000, roughly £1,700, so a steady seller crosses it fast. In a single year, HMRC received data on nearly 4 million online sellers. Take Colin, who cleared out his late father's tools on eBay, over £4,000 across the year, and assumed a one-off clear-out couldn't be taxed. Selling your own worn possessions at a loss usually isn't, but a steady run of 30-plus sales at a markup looks like trading, and eBay reported every penny straight to HMRC. And from January 2026, most sellers start receiving a copy of exactly what the platform reported about them, based on their 2025 activity. So there is no dramatic new audit team knocking on doors. What's actually happening is automated data matching. A computer compares what Airbnb or Vinted says you earned against what you declared, and flags the gap. Brian lets his spare room on Airbnb for £3,000 a summer, and assumed it was private. It isn't. Airbnb reports it, and if his tax return says nothing, the mismatch lights up, and a letter follows. The mistake here is believing casual selling is invisible. It stopped being invisible in 2024, so expect the platforms you use to send you a report of your figures early in 2026, and keep your own record of what you earned, so the two numbers match when HMRC compares them. Number 3. The nudge letter, and why you must never put it in the bin. HMRC now sends what it calls nudge letters, a short letter saying its third-party data suggests you may have income you haven't declared, rental, online sales, or interest abroad. Getting one is not an accusation and it's not a fine. It's a prompt to check your own affairs and put things right. Landlord nudge letters are arriving in 2026 at a higher rate than at any point in the regime's history. And here's what matters. The penalty depends entirely on how you respond. Come forward voluntarily with a genuine careless error, and the penalty can be nil. Ignore it, or hide it deliberately, and it climbs 35 to 70% of the tax owed for a deliberate case, plus interest running at over 7% a year. On a £2,000 tax bill, that's the difference between paying nothing extra and handing over another £1,400. Derek left his letter on the kitchen table for 3 months, told himself it would blow over, and his position only got worse. The longer he waited, the higher the penalty band climbed. so never ignore one. Respond inside the window it gives you, usually 30 days, and if you do owe something, disclose it voluntarily through HMRC's digital disclosure service. That's the cheapest way out. And remember, stay with me, because number 6 is the part almost everyone gets backwards. Number 4. The frozen allowance trap that quietly turns tiny side income into taxable income. Your tax-free personal allowance has been frozen at £12,570 since April 2021, and that freeze has now been extended all the way to April 2031. Meanwhile, the full new state pension rose 4.8% in April 2026 to £241.30 a week. That's about £12,547 a year. Look at those two numbers together. The full state pension is now just £23 below your entire tax-free allowance. That means a pensioner on the full new state pension has almost no tax-free room left. So even £100 of side income tips you over the line and gets taxed at 20%. Picture Ron, full state pension, plus £500 a year from mending clocks for neighbors. Nearly all of that £500 is now taxable, so he owes around £100 in tax on a hobby he assumed was free. That's fiscal drag, and it hits pensioners hardest. The mistake is the comforting assumption, I'm retired, I don't pay tax. 5 years ago that was often true, when the pension sat nearly £2,000 below the allowance. Today, with the pension nearly filling your allowance, it usually isn't, so add your pension and your side income together. Anything above £12,570 is taxable, and the safest habit is to set aside 20% of every side pound the moment it arrives. Number 5. The 2 dates that decide whether you pay a penalty. For side income you received between the 6th of April 2025 and the 5th of April 2026, there are 2 hard deadlines. First, you must register for self-assessment by the 5th of October 2026. Second, you must file the online return and pay any tax owed by the 31st of January 2027. Miss the filing date and you get an automatic £100 penalty even if you owe no tax at all. Then, after 3 months, £10 a day up to a further £900, and at 6 and 12 months another 5% of the tax or £300 each time, whichever is greater. A forgotten return can cost well over £1,000 in penalties on top of the tax. This is money thrown away for nothing. Sandra, from our first point, registered late and paid £100 plus interest on top of the tax, a completely avoidable loss, and she was lucky she caught it before the daily charges started. So don't wait for a letter to prompt you. If your gross side income is over £1,000, register now at gov.uk, put both dates in your diary, and file early, so a small tax bill never turns into a penalty as well. Number 6. Making tax digital. And this is the one most people get backwards. The panic going round is, making tax digital starts in April 2026, so now I'll have to file every 3 months. Here's the reality most pensioners have upside down. Making tax digital for income tax from April 2026 only applies if your qualifying income, that's sole trade plus gross rental, is over £50,000 a year. It drops to £30,000 in April 2027 and £20,000 in April 2028. And this is the crucial bit. Your pension income does not count toward that threshold at all. So a pensioner with a £3,000 side hustle is nowhere near making tax digital and won't be filing quarterly. They'd need to earn more than 16 times that from the side hustle alone before it applied. On top of that, the government has signaled raising the trading allowance from £1,000 to £3,000. Not law yet, but coming. And it would lift hundreds of thousands of small sellers out of reporting entirely. So the paperwork most people are terrified of is far lighter than they think. But here's the trap that catches them. They hear making tax digital doesn't apply to me and conclude, so I don't need to declare anything. Wrong. Take Pauline. Sold £1,500 of vintage china on eBay, decided making tax digital was for big earners, so she filed nothing, and got a nudge letter anyway. You still must declare side income over £1,000, quarterly filing or not. Her £1,500 was over the trading allowance, so the return was owed regardless of the £50,000 threshold, and she still faced the £100 late penalty. The duty to declare never went away, only the heavy paperwork did. So here's your one job this week. Sit down and add up every pound of side income since the 6th of April 2025. Gross, across every platform, before any costs. If it's over 1,000, register for self-assessment before the 5th of October. If it's under, keep the record anyway, because the platforms have already sent theirs. If this helped you, subscribe and share it with someone over 60 who has a side income. The ones who find out in time are the ones who keep their money.